Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. I'm Ryan Nauman, the market strategist here at Zephyr. Whether you are a portfolio manager at an investment management firm or a wealth manager managing the assets of a client, identifying and managing risk is one of the most important, if not the most important task for these investment professionals. Well, I have on the perfect guest to discuss the management of investment risk today, a conversation that I have been looking forward to for some time. But first, today's episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions. I'd like to give a very warm welcome to Brad Wheeler. Brad is the president at the PSN Top Gun award-winning firm Shaker Investments. Brad, thank you so much for coming on the show. It's an honor to have you on. Can you please tell us a little bit more about yourself and Shaker Investments?
Sure, and Ryan, thanks for having us on the podcast. We really appreciate it. Shaker. I'll start with myself, but Shaker Investments, we're based in Cleveland, Ohio. And I've worked on Wall Street for 25 years. Started on the sell side with a firm called Midwest Research. They had spun out a group called Ralston Company, which is a Cleveland institution in the money management business. Okay. This group focused strictly on sell side research, no investment banking, no money management. I called on mutual funds in Boston and hedge funds and endowments in Boston.
Yeah, okay.
And, provided them with research and stock ideas, with the goal of helping them make money and getting them into stocks early and hopefully getting them out of stocks early. Sometime around 2005, Midwest made a decision to move into investment banking. Oh. And that kind of changed the outlook for how our clients had viewed us because we were always known for our independence.
Yeah.
And with that, a group of us spun out, and I was one of the founding partners of a firm called Cleveland Research. So we went from Midwest Research to Cleveland Research, literally right across the street, and went back to our roots of just doing research in the industrial, healthcare, tech, and consumer sectors. And it worked. We were known for being independent. We were known for being out of the groupthink of the money centers. And I think I was viewed as sort of the eyes and ears for people in the Midwest who were investing. Fast forward to 2018, I got a call from an executive search firm out of New York for the Shaker Investments job. And, I originally declined. I said, I don't think I'm ready to move to the buy side. And they were persistent. And so I spent some time with Edward Hemmelgarn, our founder and CEO. I knew him personally. I didn't know him professionally, and got to understand his vision. And then met with his sons. Chris and Brandon are both in the business. Brandon's our co-CIO. Chris is a portfolio manager in our products. It's not uncommon for family to be in the business together in this industry. And I grew to think this was a great opportunity. I made the entrepreneurial jump to Shaker in 2018 as the head of sales and marketing. So that's sort of my background, and that's how I ended up here. The funny story Edward tells is, "Hey Wheeler, I spent a lot of money on a New York search firm, and you live 5 blocks away from me. Why didn't you tell me you're looking for a job?" And I said, "I wasn't looking for a job at the time."
And that is fantastic.
We've joked about that. With Shaker, a brief background. We're an asset management firm. We specialize in small cap growth stocks. We run 3 strategies: a small cap growth strategy, a fundamental growth strategy, and then we have a long short hedge fund. Okay. It's long biased with a large component of small cap names, which I think is a little different for a hedge fund. We really like the niche that we're in. Small cap stocks. We think an active manager can add value there. The less covered a company is by Wall Street, the more we like it. It allows us to, do our own due diligence and our own thinking. The firm, as I sat down with Edward and talked about where we're going, the firm used to be, before the great financial crisis, we were over $2 billion in assets. it shrunk over time as every firm was fighting to survive, and he basically shut it down and ran it like a family office in 2009. Partner capital and clients that stayed with us. And today we're at a little about 300 million. We've got aggressive goals to get to 1 billion over the next 4 or 5 years. We haven't seen a small cap bid from the market. We're starting to see a little bit of a bid. So we like where we are. We like where we're positioned.
Mhm. I love it. Well, it's a fantastic story. I love it. And you probably had some good stories about, going from in your previous firm, going from being independent to bringing on an investment bank or offering investment banking, because that glass wall, right? That's in the time when people were clamoring about that glass wall and removing it and are
Yeah,
putting up a wall between research and investment banking. Interesting time back then.
yeah, it was, and I think it's funny when you're calling firms in Boston and New York and any money management center, you're competing with 100 different people every morning, and it's like my call was always an independent call, and once that changed, I just found you saw the responses taper off, and
Yeah.
so that's why we made the move.
Interesting. Interesting. I love it. Well, you guys are doing fantastic work at Shaker in that small cap space. As I said at the open, a PSN Top Gun award winning, you have strategies over and over. So fantastic work by your team and your investment team. So, you know, this may sound basic to some, but I think it's important to start at the top. Why
Mhm.
is risk management important in the investment management space? And do you think, sometimes it's a lost art?
Um, Sometimes, especially in up markets when it's cliche, but the rising tide raises all boats,
Mhm.
and maybe risk management isn't as important. It's always important, but maybe not as important when there's just a lot of capital out there. And I think at Shaker, the way we think about risk, we're an active manager. We're always looking for the best stock in each sector. We run concentrated portfolios,
Okay.
but we try to identify how is it identify and analyze any uncertainty or things that could go wrong. That's where we see, that's where we really try to mitigate that part, and we talk about it constantly, especially when we add a new position to the portfolio. um, how do we manage? We always think something's going to go up. I hope it does, but we also say, okay, how do we manage this if it doesn't? And you'll never bet 100% in this
Yeah.
industry. It's a hard business, but we recognize that, and we say, okay, let's figure out in the bad times how things are going to work. And that's what we try to model that and try to figure out how we can help our clients and minimize that downside protection.
Yeah. Fantastic. So you bring up a good point about the individual stocks and, maybe the risks there. How do you separate, that stock specific risk? Is there a crook at the top, or, is there something wrong with that firm that has different risks than maybe more market risk or macro risk with the Fed? How do you separate that, and how do you manage both, or do you not maybe manage both?
No, we do, and I think there's really two questions there, like sort of the individual stock risk that we think about, and then maybe the macro themes. Um, to get a stock in a Shaker portfolio, you go through a process. There's a 40-page slide deck, and we have 11 characteristics that are important to Shaker, and you got to check the boxes. And you don't have to have all 11 checked. If you do, we might do a larger starting position in that stock, 2 to 3%, because it's a perfect, what I'll call shaker stock. And these characteristics, some of them are basic. We're a growth firm, so growth is one. But we don't like conglomerates. We like single niche companies because we think they have upside. And we're looking for those companies in the business cycle where they're starting to ramp, and we can own them for a long period of time. But those characteristics, if we only have 8 checked, maybe we'll do a 1% position in a stock until we get till we watch it trade or get some of the concerns identified that came up in the research meeting. Um, so from an individual stock standpoint, our process helps with the risk. identifying risk. And then from a macro standpoint, we're all, the portfolio managers are always thinking about, what's going on in the business cycle, the economic cycle, the monetary cycle. But we meet every Wednesday at 1:30 as a research team, and I'm on the research team. Anthony Panuno, our trader, puts together a 30-page deck, and we talk about some of the issues that are out there. And we have 150 years of collective Wall Street experience in this office, and we think about risk, and we think about what's going right, what's going wrong in certain economies, and a lot of it comes back to those 11 characteristics. Are they still being checked the right way? And COVID showed that really how well those worked. I mean, we owned an airline during when COVID kicked in. Guess what box was no longer checked? That box, and we got out of that stock. Yeah, and we owned a restaurant, and nobody knew that box is no longer checked, and we actually lowered the position. We also own some SaaS companies that if you get a little bot that pops up on your computer to help you at like a car dealership, we thought those type companies would do better, and so we added to the positions, and we never really we use those characteristics to help guide us from a risk standpoint. Um, and we also have some rules in place that I can get into later that about position sizing and sector allocation, things like that have helped protect us. So we've got, getting back to your question, stock specific things we look at through those characteristics, and then macro issues we talk about every week. So
Yeah, you have to talk about the macro issues every week. It's moving so quickly. And then with the Fed, always, you know, whenever a Fed official speaks, it seems like it moves markets. And it's one of those things that it's very fluid, as they say.
yeah,
Talked, you mentioned briefly about Shaker and how you manage risk. How do you guys view risk when you think about risk? We're a little bit on the other side. We help financial advisors manage risk and look at investments and how do you determine what is important for your clients? Are you trying to manage downside risk? Are you trying to manage volatility? What type of risk do you try and manage?
I think you're thinking about everything. So but I think the big thing for Shaker, um, we used to really outperform in up markets and in coming out of recessions, and we still do. And why we think we did that was because we think we find the best stocks in each sector when things are good. Shaker did extremely well, but in downturns, that's when we would underperform, and that's when we took a hard look at our portfolio and said, how can we help our clients understand, and how can we improve that downside capture is what we were really focused on at the time. And and we got a lot of this information from our clients actually. We changed a few things in how we look at our portfolios. One, we bench the indexes we benchmark against. We want to be plus or minus 5% within those sectors allocation.
Mm-hmm.
So we're not closet indexers, obviously, but we don't want to take outside risks in a sector. We want to let the stock picking be the piece that drives the alpha. And a good example was in 2014. I wasn't there, but I've done a lot of work on it. Healthcare was at 21% of the benchmark. We were at 11.
Okay.
And when healthcare took off, guess who didn't take off? Shaker Investments. We're too underweight. And it happened on the other, it happened on the downside too. We were overweight financials at one point. Financials took a downturn. We underperformed. So we changed that. It was only a small thing, but it actually really, and you can see in our attribution numbers, like over that period, 7-year period, what's driving the return. And it's a stock picking. It's not being underweight sectors. So that's one thing we've changed to help our clients, and they'd asked for that. We had some municipalities and some institutions. They didn't want us taking outside risk.
Okay.
The other thing that we did was small, but surprised we hadn't done it in the past. Position sizing of 8%, nothing more than 8%. There's portfolios out there that are very concentrated, 10 stocks, 10 best ideas for people. That's just not what we do. If you hit 8%, that's our threshold. The portfolio manager and the CIO, they'll trim those back to, we'll take some profits. And in the portfolio today, I think our largest position is about 6.3, and I don't think there's the next second largest is under 5. So we've really, we look at it's basic, but we also, and you got to remember, if you get to 8%, that's a good thing. So we started at 2, we got to 8. That means the stock has performed.
Yeah.
So we've really tried to, some small things, and they've really impacted the portfolio from a risk standpoint. And our clients have said, yeah, this is what we're looking for.
Great. Again, it's like in all industries, whether you're a financial advisor, asset manager, like yourself, you got to listen to your clients, right? Listen to your investors. Make sure you enhance that client experience. Make
Hmm.
sure you're answering that call. So, what are the first steps to managing risk? Is it identifying the risk that you want to try manage? Is it, managing risk? I don't think is as easy as what maybe it sounds.
You know, I, I agree, and I think the one thing that's harder to explain to people is risks are always changing,
Yeah.
and I often am asked, "Hey, what's the biggest risk?" And I say, "Well, it depends on the time period, depends on the day." I mean, if the Fed's talking, and we don't turn the portfolio that much, but
Mhm.
um, it depends where you are in the economic cycle and the business cycle. Again, I mentioned we try to own stocks for 5 to 7 years. The one thing Edward said when I joined the firm is, if we're gonna own a stock, I want to own it for a while. Let's do the work on it. And so the answer to your question is, I just think it changes, and um, we're always looking at where these stocks fall. And I think getting back to those characteristics help us define that.
Mhm.
Um, um, because when those change, that means the risks are changing in the portfolio. Um, you know, one risk that wasn't there in the past was when the U.S. and China had a very strong relationship. We had several companies that had a lot of exposure to China. What changed in those businesses? Did the business change? What changed was our relationship with a foreign country, and so we lowered our position in some of these names. And again, it's just something we're constantly monitoring in those characteristics. And our PMs and our trader look heavily at the full portfolio, and the analyst and PMs who own those stocks look at those individual stocks.
Mhm. You're exactly right about the risk that I often talk about the wall of worries, right? And it seems like that wall of worry and wall of risk change all the time, like geopolitical. It's probably a more complex geopolitical landscape than ever.
Yeah.
Um, you have elections coming up across the globe, not just here in the US. And then you have just that economic uncertainty of, is the Fed laden uh, easing policy to, or are we going to hit a recession? There's just so many uncertainties, and makes managing risk, I think, much more difficult.
Yeah, and this is going to sound strange, but it kind of what makes the job fun.
Yeah.
I mean, you wake up and, and your stock's down because of something that you didn't really anticipate, but you figure out where it is and what happened, and you learn from it. But that's what makes it hard, but it also, I think, makes it enjoyable. When the jobs numbers came out last week, I think everybody was shocked at the strength of the numbers, and we're like, and we were too, but
Yeah.
still, that's what makes a job fun. It makes it it's a hard job, but if you do it right, you put in the time and effort, and do the blocking and tackling, it's rewarding.
You know what, Brent? That is spot on. That's one reason why, like, you wake up in the morning, you might look at the markets, or maybe, but you just have no idea what you're going to wake up to. You might
Yeah.
think the market's going to be up one day, and it's not. We always had lately, we've had good news as bad news on the economic side. It's just uncertainty. But you also made a very good point. When I started in this industry, one of my mentors, he was just fantastic. He always said, within crisis is opportunity. And it doesn't even have to be crisis, but it goes along with what you said when, there's all this uncertainty, maybe volatility, it gives you a chance to shine. Gives, whether you're a financial advisor or asset manager, gives you the chance to shine and show your value and
Mhm.
separate yourself from your competition. If markets are up all the time, it's easy. I mean, you're just one of a thousand. But
Yeah, and I found when I first started at Shaker, that was an issue. The markets had been going up consistently, and everyone saw this. But at times, people were underperforming that benchmark, and they didn't realize it. They just saw that incline of that slope going up. And I told Edward, we need a recession or a downturn to hopefully wake some people up. But yeah, but you're right. It's like it's fun. I think the job was probably a lot different 30 years ago without cell phones, which would have made it different. But it's still challenging, still in its own way. But you're right. You wake up in the morning, you look at your phone, you're like, oh, here's what's going on. But that's the start of a new day, and um, we think long term. But I told my son, who's graduated as an investment banker now, in this business, the game starts at 9:30. At 4 o'clock, it stops. You know what the score is, and then you get ready for the next game. That's how I think about
yeah,
our job. But I think of it over the long term. But every day you're playing, so that's just how it is.
yeah, exactly. It's fun to play, I think. Hard though, like you said.
Hmm.
Let's real quickly. You talk about active management, and I often say, and done some research in Zephyr that volatility helps active managers, just like what we've talked about. And when markets are up, it can be hard to beat the benchmark
Yeah.
or separate yourself. Is that what you guys find? Or, when markets are up, how do you separate yourself as an active manager?
When markets are up, it is more challenging. I think um, what we try to show and what we try to do is, I and we won these awards from Zephyr and from Morningstar. I think about it over a 3 to 5 year period. That's how I think about things. So, if the market's up that entire period, which is I think rare, that's great. But often I can show the cycles of how we competed in up markets, down markets, and how we have lately been out of the last 6 years outperforming in those down markets. So I try to think more when I present and talk to people. We're in this for the long haul. The biggest investors at Shaker are the partners, and so we think about markets over a 3 to 5 year period. But when they're down, I think that's when we've been able to shine a little bit more by showing our how we performed in the last several downturns, because you're trying to protect capital as much as you can. Um, I told my wife, hey, we beat the benchmark, but we lost money. I go, well, you can't eat you can't eat that because we lost money today. But you do. You want to show that in downturns you can perform, because I think in upturns it's a little bit easier for people.
What I view, and I've had a lot of guests on talking about the investment analytics and are we viewing risk wrong? I often think, we often over years talk about standard deviation. Fantastic, granddad of all risk statistics or volatility. But it's like, I think it's time that we not focus so much on standard deviation, because upside standard deviation is not bad. Give me all the upside standard deviation
Yeah.
you want to give me. It's that downside. To me, investment risk is losing money.
Hmm.
I don't want to lose money, right?
Hmm.
So protect that downside, protect the losses, give me, protect the downside. So then you have more assets to, you know, appreciate during the recovery. Um, and I like that you talk a lot about, and your firm focuses on protecting the downside, reducing that down capture so you can recover quickly.
Yeah, that's it's talked about a lot, especially in the small cap side, where over the last couple of years, the largest seven stocks have been moving the market, and small caps kind of treaded, sideways or downward, or headed downward some. And lately, it's continuing to go up a little bit. But during that period, that we talk every day about how can we, if it could take longer, but how do we protect that downside? And we don't. The one thing we won't do, though, we're paid to invest. So like 5% is our cap for cash, and people don't want us to put.
Yeah.
We're not paid to put money in cash, and so we do try to find the best names. And Um, but during downturns, we might add a few more positions to the portfolio, especially just to diversify a little bit.
Yeah.
But typically, try to do 40 to 50. And during downturns, we found that we typically have right around that 50 number.
Fantastic. We've talked a lot about just managing risk. What are some different risk management strategies that investors can implement? Hedging, or is it just diversification?
Um, yeah, and I I think there's really a couple things that we talk to people about, especially our high net worth individuals. Um, it sounds basic, but know what you own.
Mhm.
Um, and a lot of times, if you're older, you need fixed income, you need some other less risky asset. We've had people come to us, can you take a look at our portfolio? Tell me what you think. Ashley, our senior, works with me. She's CFP. She was top woman by Hub Advisor. She's doing really well. She'll go through the portfolio and explain to them, hey, given let's talk about goals, but also where you are from an age standpoint. Maybe there's a little bit too much risk in this portfolio. So one thing that we talked about is know what you own. The other piece is diversification, obviously.
Yeah.
And for us, we struggle with like know what you own. Like we've looked at crypto. We've done a lot of work. There's some crypto small cap names out there, and we understand it. We know it's an asset class that's working at times, but we can't really model it. In our small cap portfolio, each company has its own independent model, and so we've shied away from that just because
Mhm.
we can't. It's not bad. It's not a bad asset class. Just we can't get our arms around how that model would work. And so we've talked to people about that. Said, hey, if you understand it, you're comfortable in a certain percentage, we get it. But we've chosen not to go that route for now.
Mhm.
Um, the other thing I think people miss sometimes is like the largest seven tech stocks had done extremely well. But if you own those individually, but you also own a mutual fund that's and an index fund, you may have larger exposure to some of those names than you think. And um, talk to your advisor. Make sure that make sure you know where you stand with some of those names.
Yeah. I think you're spot on about overexposures. Know what you own. You buy Spider, the SPY, and all of a sudden you might be overweight tech and you don't know it. My common example with that is the Bloomberg Barclays egg, which is
Hmm.
now like a huge percent. I don't know the exact percentage, but a very large percentage of that is in treasuries, right?
Hmm.
And you may not think that when you're buying, what is supposed to be a corporate index, a credit index, and most of it's in treasuries. So you're exactly spot on when you're building that portfolio. Know what you own, know what's in those investments. Brad, this has been really great conversation. I always like to end it with a fun story, something interesting, maybe what you've experienced. Right? It could be market related, maybe a
Right.
fun story, or it could be outside of markets.
Okay. Fun story. Okay. I think I've got one here. Um, uh, I went to the Guardians Tigers game yesterday, and that wasn't that fun at the end because we lost, but we'll bounce back. But the Tiger fans, they travel well. I mean, they were loud. Uh, they were a little obnoxious, but they were winning. And the guy next to me was a Tigers fan, and he said, and about sixth inning, I think it was sixth inning, he goes, I almost missed the game because my meeting ran late. And I said, oh, what do you do? And he said, oh, I'm a wealth manager.
Oh,
And I said, oh, I said, we're an asset manager. I told him what we did, and we exchanged cards. And they say sports brings you together, but I also was like, all right, well, finance actually might be bringing us together.
yeah.
So I said, hey, I'm going to be in Birmingham in a month. He's like, and he was probably in a good mood because they won. But he said, oh, stop in. I'd love to hear about your product. So anyway, this is I don't know how funny it is, but the guy next to me was, driving me crazy for the first 7 innings, and then I gave him my card, and who knows, we may get together in a month in
That,
Birmingham.
and that's awesome. I love it. I'm a huge sports fan too, and as much as maybe you might dislike a team or something, you just never know about those connections, and you can't necessarily write them off right away. But yeah, I have so many friends connections. It's such an easy way to start a conversation. Oh,
Yeah,
you know I'm from Wisconsin, so it's like always talking about the Packers. Even though I'm
Yeah.
not a Packers fan, you just start the conversation of talking about the Packers, and you go from there.
Yeah.
So, Brad, thank you so much for coming on the show. Such a fun conversation. I love talking about the investments and risk management. We could talk for hours here, but where can our audience get more information about Shaker Investments?
Sure. Our website's shakerinvest.com, and
Okay.
gives a pretty good description of it gives a good description of the firm, but also the our long only products, our hedge fund. You have to be an accredited investor, but just give us a call, fill out some information. We can get that information out to people too. So
Fantastic. Awesome, Brad. It was an honor to have you on. Thank you so much. Thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch or listen to past episodes on the Zephyr YouTube channel, as well as on Spotify and iHeartRadio. Thank you, and have a great rest of your week.
thanks, Ryan.